Warranties. A warranty is a written guarantee of the integrity of a product or service. The seller also agrees to repair or replace a product, refund or a part, refund or part of the price, or provide additional service. A warranty is customarily offered for a limited time, such as 2 years. It may or may not be separable. A warranty that provides a customer assurance that a product will function as expected in accordance with agreed upon specifications in assurance type warranty. A standard 1-year computer warranty against manufacturing defects is an example. If a customer does not have the option to purchase the warranty separately, or if the warranty is required by law, it is an assurance type warranty. A warranty that provides a service in addition to assurance is a service type warranty. An example is a warranty against customers' inflicted damage, such as to a smartphone. A warranty cannot be purchased separately by the customers is a service type warranty. Service type warranties are more likely to have a longer coverage period than assurance type warranty. Assurance type warranties. An assurance type warranty is not a separate performance obligation in a contract. No transaction price is allocated to the warranty. An assurance type warranty creates a loss contingency. Accrual accounting should be used if warranty expense is probable, the amount can be reasonably estimated, and the amount is material. A warranty liability is recorded when revenue is recognized at the time of sale. Even if the warranty extends beyond the period of sale, the entire liability or expense for expected costs is recognized at the time of sale. It is not prorated over the annual periods covered by the warranty, beginning warranty liability at warranty expense recognized in the current period and minus warranty payments for the current period equal ending warranty liability. Actual payments for warranty costs reduce the warranty liability and do not affect warranty expense. If warranty payments for the period exceed the warranty liability, the excess is recognized as a warranty expense. Service type warranties. A service type warranty is a separate performance obligation in a contract. A portion of the total transaction price is allocated to the service type warranty. The total transaction price is allocated to the service type warranty and the related products sold based on their estimated standalone selling prices. At contract inception, the consideration received for the service type warranty is accounted for as an advance payment, and a contract liability is recognized. Revenue from a service type warranty is recognized over time. Over the coverage period, the pattern or revenue of revenue recognized from a service type warranty depends on the way the warranty performance obligation is satisfied. If warranty service is provided continuously over the warranty period, revenue is recognized on the straight-line basis over the coverage period. If warranty service costs are not incurred on a straight-line basis, revenue recognition over the contract's term is proportionate to the estimated service cost. Warranty expense is recorded when the entity pays a claim under warranty. If an assurance type warranty and a service type warranty cannot be separated, they are accounted for as a single performance obligation as a service type warranty. Leases. A lease is a long-term contract in which the owners of the property, the seller, allows another party, the lessee, to use the property for a stated period in exchange for a stated payment. The primary issue is whether the lease agreement transfers substantially all the benefits and risks of ownership to the assets to the lessee. Lease classification test. A lease is classified as a finance lease by the lessee at lease commencement if at least one of the following five criteria is met. One, the first, the lease transfers ownership to the lease asset to the lessee by the end of the lease term. Second, the lease includes an option to purchase, commonly referred to as a bargain purchase option. The leased assets that is the lessee is reasonably certain to exercise. The lease term is for the major part of the main economic life of the leased asset. In this item, a lease term of 75% or more of the remaining economic life of the leased asset generally is considered to be a major part of its remaining economic life. This criterion is inapplicable if the beginning of the lease term is at or near the end of the economic life of the leased assets. This period generally is considered to be the last 25% of the leased assets' total economic life. The fourth, the present value of the sum of the lease payments and any residual value guaranteed by the leases equal or exceeds substantially all the fair value of the lease asset. A present value of 90% or more of the fair value of a lease asset generally is considered to be substantially all of its fair value. The leased asset is so specialized that it is expected to have no alternative use to the leaser at the end of the lease term. When none of the five classification criteria described above are met, the lease is classified as an operating lease by the lessee. Leases accounting, initial measurement for finance and operating leases. A lessee must recognize a lease liability and a right of use asset at the lease commencement date. Finance and operating leases result in the same accounting for initial recognition and measurement of the lease liability, initial recognition and measurement of the right of use assets, subsequent measurement of the lease liability. The transaction analysis for finance and operating leases differs, but the ending balance is the same for the lease liability under both types of leases. The accounting for subsequent measurement of a right of use assets differs under finance and operating leases. Lease liability. At the lease commencement date, a lease liability is measured at the present value of the lease payments to be made over the lease term. The lease payments used to calculate the lease liability depend on the specific terms of each lease contract. If the lease includes a purchase option that the lessee is reasonably certain to exercise, the lease payments consist of the following: rental payments and exercise price of the purchase option. If no purchase option exists, the lease payments may have the following three components: rental payments, any penalties for terminating the lease, non-renewal penalties, and amounts probable of being owed by the leases under residual value guarantees. Right of use assets. At the lease commencement date, a right of use asset is measured at the amount at which the lease liability was recognized, plus initial direct costs incurred by the leases. When no initial direct costs were incurred by the leases, a right of use asset equals the lease liability recognized. Subsequent to an initial recognition, the right of use assets is reported in the balance sheet at cost minus accumulated amortization of any impairment losses. Leases accounting for finance leases. Subsequent measurement, lease payment. Each periodic lease payment made by the lessee has two components: interest expense and the reduction of the lease liability. If the first periodic lease payment is made at the commencement date of the lease, its only component is the reduction of the lease liability. Now, interest expense is recognized for the first payment because no time has elapsed between the lease commencement date and the payment. Interest expense is calculated using the effective interest method, as also known as the effective rate method for the interest method. It is calculated as the carrying amount of the lease liability at the beginning of the period times the discount rate of the leases. Yeah, as you can see. Interest expense equal lease liability at the beginning of the period and times or multiply with discount rate. The reduction of the lease liability is the excess of the periodic lease payment over the interest expense recognized during the period. Reduction of lease liability equal periodic lease payment minus interest expense. Amortization of a right of use asset. A lessee amortizes the right of use asset on a straight line basis. The right of use asset is amortized over the shorter of its useful life or the lease term. However, if at the end of the lease term, the ownership of the lease assets is transferred to the lessee, or the lessee is reasonably certain to exercise its purchase option, the amortization period is the useful life of the lease asset. Lease is accounting for operating leases. Subsequent measurement. As noted previously, accounting for finance leases and operating leases is the same for initial recognition and measurement of the lease liability as a right of use assets. Subsequent measurement of the lease liability. The transaction for the lease payment and reduction in the lease liability is different than the finance lease transaction. However, the ending liability is the same. The following are the differences in accounting for finance on and operating leases. Subsequent accounting for amortization of the right of use asset, income statement presentation of interest expense, and amortization of the right of use asset, statement of cash flow classification of cash lease payments. A single equal lease expense is recognized in each period. It is calculated so that the total undiscounted lease payments are allocated over the lease term on straight-line basis. Single period lease expense equal total undiscounted lease payments divided lease terms. Initial direct costs incurred by the leases are included in total undiscounted lease payments. They are recognized in the single period lease expense on a straight line basis over the lease term. The single periodic lease expense has two components: interest expense on the lease liability and amortization of the right of use assets. In the income statement, a single amount for the total lease expense for the period is reported in income from continuing operations. Interest expense for the lease liability and amortization expense for the right of use assets are not reported separately. Financial statements, presentation summary, balance sheet presentation. Finance leases and operating leases report the lease liability. The lease liability is allocated between current and non-current portions. The current portion at the balance sheet date is a reduction of the lease liability in the upcoming year. Financial lease liabilities and operating lease liabilities must not be presented together in the same line item. They are presented in the balance sheet or disclosed in the notes, separately from each other and separately from other liabilities. Finance lease right of use assets and operating lease right of use assets must not be presented together in the same line term. They are presented in the balance sheet or disclosed in the notes, separately from each other and separately from other assets. If the type of lease is finance lease, income statement will be shown with interest expense and amortization expense. and our statements of cash flows. There will be principal portion of lease payment is financial cash outflow, and interest portion of lease payment is operating cash flow. And with operating lease expense will be expressed on the income statement, and lease payment is operating cash outflow. Short-term lease. A short-term lease is a lease that, at the commencement date, has a lease term of 12 months or lease and does not include a purchase option that the lease is reasonably certain to exercise. As an accounting policy for short-term leases, a lessee may elect not to recognize the right of use asset and the lease liability. Under this short-term lease exception, the lessee recognizes lease payments as rent expense on the straight-line basis over the full lease term. A short-term lease is a form of off-balance sheet financing. The lessee has the right to use the leased assets, but neither the asset nor a liability for future lease payments is recorded in its financial statements. Lessees may prefer to account for a lease as a short-term lease instead of as a finance lease to avoid recognition in the financial statements of a liability for future lease payments, interest expense, and depreciation of a lease assets. Payments for short-term leases are cash outflows from operating activities.